Unusual whales is a trading tool that alerts you when large trades are being made in the market. The idea being that there are hedge funds and other big players out there who might have more information than everyone else, and it might pay to follow these players into their positions. The tool does a bunch of different types of alerts, but for this series, I'm going to be focusing exclusively on options. What I like most about Unusual Whales is that the people who made it are fairly transparent. Without signing up, anyone can go to their site and download a list of every single alert that was produced all the way back to June 2020. Because all of this data is freely available, we can do our own analysis to see if the idea of hunting whales has any merit, and perhaps if we can increase our chances of profit by hunting whales more selectively. In order to do the type of analysis that I want, I'm going to have to make some adjustments to the raw files. For this series of posts, I'm going to be looking at the time between December 2020 and April 2021. The reason I'm starting in December 2021 is because Greek values were only recorded by Unusual Whales starting in that month. One of the variables that I think might be important in hunting whales is days to expiration. And if you look at the data, there's a column titled Days to Expiry. However, you'll quickly notice that a lot of the numbers are negative. It turns out that column records the number of dates from the date the report was created to the expiration date. So all the alerts that have already expired when the report was created have negative value. I'm not sure why anyone would want to know this information, but it means that column is not the actual days to expiration that we want, and we're going to have to create it ourselves. Thankfully, all the necessary information is already in there. Simply populate a new column with the difference between the expiration date and the alert date in number of days. Another variable that I think is important is the number of days it took that option to reach its high point. Again, all the information is there. Simply populate a new column with the difference between the high date and the alert date. And finally, the last modification that I like to make before I start the analysis is adding a column for adjusted high return. The report comes with a column titled high return, but this is the high price over the midpoint of the bid and ask at the time of alert. Presumably the high column is also the midpoint between the high bid and the high ask, but I'm not entirely sure about that. Now I don't know about you, but whenever I buy options, I almost always get a price that's closer to the ask than to the bid. So just to be a little more conservative in calculating returns, I like to use the ask price at the time of alert as my cost basis. My broker Schwab also charges 65 cents per contract for each trade, so I add that onto the buying price and take that out of the selling price when I calculate my return. The first step in the journey to developing a whale hunting strategy is to determine which variables we want to focus on and which variables we want to ignore. The site allows you to filter your alerts based on a bunch of variables. I have chosen 12 of these variables to do further analysis. For each variable, I did a t-test to determine whether the mean for that variable is higher or lower for winners as compared with losers. Winners are defined as alerts that reach a certain return, and losers are the ones that don't. I will run a separate test for a variety of win definitions. I'm going to use a 2-sample t-test, with 2 samples being the winners and the losers. I'll be using the Welsh approximation so that I'm not assuming that the variances and standard deviations of the 2 samples are equal. And finally, I'm only going to do a one-tail test because I'm just trying to determine whether the mean for winners is higher or lower than the mean for losers. Here's my null and alternative hypothesis. After doing a t-test for all 12 of my variables with several definitions of winners, here are my results in the form of p-value. If the p-value is less than 0.01, we can reject the null hypothesis with 99% confidence. If the p-value is less than 0.05, we can reject the null hypothesis with 95% confidence, and so on. If the p-value is greater than 0.1, we will not reject the null hypothesis. I'm going to start with the calls first. Buy amount and ask are significant at the 99% confidence level for every single win definition. Bid and expires in miss the 99% confidence level for a single win definition in which they do have significance at the 95% confidence level instead. Delta, Vega, and Gamma are also significant for all win definitions, except there is no significance at the 10% win definition. Implied volatility looks more significant for higher win definitions, and vice versa for theta. Open interest and volume open interest ratio have some pockets of lower significance, and volume is not significant at all for any win definition. Now, using the same methodology, let's look at puts. Expires in and vega are significant at the 99% confidence level for every single win definition. Delta, ask, buy amount, bid, and implied volatility miss the 99% confidence level for a single win definition in which they have significance at the 95% confidence level instead. Interestingly, theta looks like it's more significant for higher win definitions, which is the exact opposite finding we had for the calls. Volume open interest ratio has some pockets of significance, but the findings largely correspond with what we saw for the calls in that volume and open interest are probably not worth looking at. What was surprising for me is that gamma, which was significant for calls, is not significant at all for puts. Here's a summary of my results, with the shades of green being reliable variables, yellow being less reliable, and red meaning you probably shouldn't rely on those variables at all. What really stood out for me is the lack of significance for variables such as open interest, volume open interest ratio, and volume. If you look at most of the whale hunting strategies shared online, they almost universally look for larger volumes, lower open interest, and higher volume open interest ratio. But if you're to believe the analysis in this video, these variables are not capable of distinguishing winners from losers. Your strategy actually might benefit from ignoring these variables altogether. After doing these t-tests, I think we have a better idea of which variables to focus on and which variables to ignore. In the next part, I want to take a deeper dive into each variable by calculating win probabilities and really beginning to develop a trading strategy.